let's now get into the economy and look at matters that affect your pockets, or how the managers of the economy are managing it. But again, what is this issue about Ghana's debt stock ballooning? How do you really understand it? We're here to break it down for you to really get grasp the meaning of all of what is happening. And Isaac Ofieje, who is our lead data analyst here, has been pouring through the data and joins me in studio with some fantastic analysis of what's happening. Kofi, I mean, we are told that we pumped some 10 billion into the economy to support the city. But how has that affected our debt stock, really?
Well, in fact, we need to start the conversation from what the finance minister actually said during the 2025 mid-year budget review. He made a point that I think was very, very significant. And so we decided to keep tabs on our debt situation, because that point he made in July, I think 23rd, when he read the budget, was very important. He said, quote, "Our commitment to fiscal discipline and prudent debt management and exchange rate appreciation has resulted in significant improvements in Ghana's debt profile." He went ahead to say that public debt reduced from 726.1 billion cedis as at the end of last year to about 613 billion cedis as of the end of June 2025. This statement was very emphatic, because if you do the math, around that time, the change as a result of what the finance minister calls, prudent management and the exchange rates, stability, was above actually 150 billion cedis. And for your debt to reduce by 150 billion cedis within a span of just about 6 months or 5 months was very significant. But the story, will definitely change if you look at the factors in this equation, or the variables in this equation, because the variable that has the biggest, or in terms of magnitude, impact on the city or the debt situation is the city. So when you are able to get the city to behave in a certain particular manner, when it's very positive and it's appreciating, that is when your debt stock can reduce by that significant magnitude. Because, I don't know any other magic we can do to bring debt stock down from 726 billion to 613. It's only the exchange rate situation that can afford. Remember in
as of that time, it was hovering around 10.6.
Exactly.
Right?
That was the period where the IMF had indicated that the second quarter of that year, the Bank of Ghana had pumped in more than $1.14 billion as intervention to save the city around that time. And we understand that because we'll come to the intervention, but because of that heavy intervention, and remember, even in the IMF, report that they put out, it says that that intervention, the footprint of the central bank in the Forex market was really not something that they were happy with. And so they had to provide a document on how they were going to go ahead with this intervention and all of that. But what we know is that because of that market intervention, the city gained strength. And the government actually, said that, well, we had gold board, which was fresh inflows in terms of Forex, bringing us on average more than $800 million every month. And so we had what it takes. And I remember even the Bank of Ghana governor was asked why they were intervening, and he asked people where the sin was, because around that time they were accumulating international reserves beyond what they were expected to do so, and they were around more than 4 months of import cover, so they had that Forex muscle to come into the market to do that intervention. But Kojo, just about 6 months, or let's say 4 months down the line, the story has actually changed. This beautiful picture the finance minister painted with that big headline figure on, July 23rd, that story has changed, and has changed because of these factors that he spoke about, significantly because of the exchange rate situation, because we have been observing the debt situation of the country. And per our analysis and the data that we've tracked so far from the Bank of Ghana's summary of economic and financial data put out for November 2025, what you see is that just between the second and third quarter of this year alone, Ghana's debt stock has actually increased by approximately 72 billion Ghana cedis.
Which is between the time he read the budget in July and August. We had accumulated 71.6
within
billion.
a span of 3 months.
That's huge.
71.6 billion cedis in debt accumulation. And
let me ask the question. Yeah. Do I, as a layperson, then get that we are borrowing, or what is accounting for the 71.7?
Well, remember the finance minister said that prudent debt management or fiscal discipline, exchange rate appreciation, and other factors caused the debt to reduce by 150 billion between first and second quarter. But if you look at this 71.6 billion cedis that we are seeing as just between the two quarters, significantly, that is coming from the exchange rate fluctuations we saw in the third quarter. Remember, in the third quarter, Bank of Ghana actually scaled back in terms of their Forex intervention around that time, and the cedi moved from the 10 cedis, 25 pesos that it was to about 12 cedis. And around that time, I remember the president had earlier come to say that, well, I've spoken to the governor, I've spoken to the finance minister, and they are confident that the exchange rate will be between 10 and 12. And it was almost...
there's a level it has to be.
Exactly. And in fact, it was almost heading into the 13s at the interbank level. If you go to the commercial or the Forex Bureau side, it was even about 13 cedis moving from 10.25 to 13 cedis. It was around that time that our debt began to go up. Not simply because we were borrowing more around that time, but because of that fragile economic, background that we had in terms of the exchange rate situation and all of that. But it wasn't just because of the exchange rate.
But let's clear this.
Yeah.
When the exchange impacted, it means that there is a component of your debt which is in dollar-denominated currency.
Exactly.
And therefore, when your cedi weakens, that dollar-denominated one
would
goes
definitely go up. In fact, that is where the next slide will actually help us to break down. This is, let's start with even the total debt situation. And in fact, we need to put across that as at the time that the finance minister took over, right, first quarter, our debt situation was very, very high. 769 billion cedis around first quarter.
Because in December, the exchange rate was around, I think, 15 point something.
Yeah, 14. 15, and then came to 14.7 January there before it did its magic in,
So when it was around 14, when the MPP left office, that's where the debt stock was around 769.4.
Exactly. So simply, it wasn't also because around that time the previous administration were borrowing. It was simply significantly because of the exchange rate situation. And when the exchange rate situation improved in the second quarter, that is when we saw the debt stock falling by some 150 billion cedis.
That was really high.
Within 3 months, Kojo. And it was because around that time, the cedi had appreciated by more than 30% against the dollar. And many were asking, what is causing the cedi? And I remember we even did an explainer trying to tell people the reasons behind it, and even the Forex intervention, how gold board was helping the government to come into the market and all of that. That was a period where we got, you can see this, just check, more or less like a U-shaped curve, where the second quarter was when we got that sort of, improvement. Then in the third quarter, Bank of Ghana scales back. But remember that third quarter, if you look at our seasonal patterns of our economy, this is usually the period where people import for Christmas.
Preparing for Christmas.
Exactly. So most of the dollar,
demand
pressures we see usually occur in the third quarter. And in the last quarter, that's when we see the dollar getting some lifeline, because usually the Bank of Ghana will come in to intervene. The burgers who come in will also come in with dollars, so the supply of dollars available in the fourth quarter. But this year, something has changed. The third quarter, rather, started with a very poor performance in terms of exchange rate situation. Then in October, right? October, I remember, the beginning of the last quarter or the fourth quarter. Remember, the Bank of Ghana came in with announcing that they were going to intervene by more than $1.1 billion US dollars. And the cedi began to respond by appreciating. Then in the, November and December, when people started demanding again, Bank of Ghana at a point even got saturated in terms of sending the money to the market. They weren't getting people to buy the dollars, right? They had to bring some of them back. But the story began to change also in the fourth quarter, where fourth quarter, for the first time, I'm seeing the cedi struggle in the fourth quarter in the last 3 years. Usually, that is not the case. The cedi is usually stable, it appreciates in the last quarter. For the first time in October, I saw the cedi appreciating. It never happens like that. Even if it's low, it's a marginal appreciation of about 3%. But in October this year, the cedi actually appreciated about more than 14%.
Which means, or which could probably mean that the Bank of Ghana, knowing that at that particular quarter, at that particular time, a lot more dollars will be needed.
Exactly.
Came in with more dollars.
Exactly.
So that the cedi does not really have that beating that it usually takes.
In fact, that is what the Bank of Ghana did, and that was why we saw that story in the fourth quarter. But the story is that if you look at the second quarter, or between the second quarter and the third quarter, the cedi lost about 20% of its value.
Okay.
Right?
Okay.
And that was significantly the reason why we saw the debt rise by some 71 billion cedis. But it wasn't just because of that. Because if you look at the external component, the dollar component of our debts, right, which usually will stay stable because of the exchange rates or because of the currency situations in dollars, so nothing will really affect it. That side, when we observe between January and September, that debt had gone up by some 1.3 billion US dollars.
Okay.
The question is, this is not a part that is usually affected by exchange rate because it's already in cedi, in dollars. If you are converting it back to cedi, that's when the exchange rate takes effect.
Yeah.
But in dollar terms, the debt stock in the external, we place it in red because this is where, the main problem is coming from. Because out of that 71 billion cedis we are talking about 67 billion of that is as a result of the external debts or the exchange rate situation at the external debt side, right? And on top of that, the external debt in its real terms actually rose by 1.3 billion, dollars.
Okay.
From 28 billion cedis to about 5 billion, US dollars, 28 billion US dollars to about 29 billion US dollars.
Okay.
Even after the restructuring. And we understand that it was simply because we took in some loans, right, this year. That is why we are seeing the external components also increase. On top of that, you have exchange rate also worsening the situation.
Okay.
You look at the domestic side, which is already debt in cedis. So the dollar situation shouldn't affect this side of the debt. Even with that side, you can see that just between quarter 2 and quarter 3, that debt rose by some 5 billion cedis.
This is domestic.
This is domestic. This is debt in cedis.
But okay.
Yeah.
Okay. The one we borrowed, the treasury bills.
The treasury bill, bonds.
So that has nothing to do with dollars.
Significantly nothing to do with the exchange rate situation.
Yeah, but government is still borrowing from treasury bill market.
Exactly. So the point I'm making is that it's solely not because of the exchange rate situation. It's also because government is also borrowing.
Okay.
So you have the exchange rate, which is the bigger component of this whole equation. But if you look at it behind the scenes, on the external level, real terms, debt is going up by 1.3 billion. Domestic level, real terms, the debt is also going up by some 5 billion cedis, right? So that is also adding to the exchange rate component, which is putting a lot of pressure on the dollar or on the debt situation. Okay.
Let's bring in Professor Bokpeng. He's your friend. You guys belong to the same fraternity. Prof, grateful to you for joining us. If you look at our debt stock and how it's behaving, what's your own reading of what's contributing to the rise we're seeing? Looks like Prof, do we still have you? I want to find out from you, what your own reading is in terms of what's contributing to the rise we're seeing in our debt stock.
Okay, all right. Good morning to our cherished listeners and viewers.
We'll try and bring in Prof. Prof, do I still have you?
Yes, I'm on the line.
Okay.
Can you hear me?
If you got my question, then please take it over and help us understand what your own reading is in terms of what's contributing to the rise.
Okay, thank you very much. For me, it is not surprising. Even though from 2025, in terms of government's main budget, there was an attempt to recalibrate the fiscal framework, essentially switching from revenue-based fiscal consolidation to expenditure-based fiscal consolidation. So you will notice that in the 2025 budget, government sought to cut expenditure drastically, while revenue projection was also went up a bit. But you will notice from the 2026 budget reading that the government revenue envelope did not respond optimally to the revenue measure. So, for instance, in the first 3 quarters of 2025, there was a revenue shortfall of about 7.7 billion Ghana cedis.
Okay.
What typically would have happened with this revenue shortfall would have been that government would have gone to the market to go and borrow the difference. That would have shot up our borrowing. But government chose to rather cut expenditure in order to keep to the primary balance of 1.5% consistent with the IMF supported program.
Okay.
But they ended up doing around 1.6% and all of that. This also helped in bringing our debt to GDP ratio to about 45%. However, if you look at the expenditure revenue interaction, you will notice that government had projected actually to borrow in the 3 quarters of 2025. I'm saying the first 3 quarters of 2025 because government at the beginning of the year had passed the expenditure in advance of appropriation, which was to cater for the first quarter of 2025. In fact, this probably should have been passed before the year end, which would have enabled government to spend in the first quarter of 2025. This happens typically after every election, where the transition takes about the first quarter of the year, and therefore the Public Financial Management Act, together with the Constitution as a main framework, would allow the government to present the expenditure in advance of appropriation for the first quarter before the main appropriation comes into effect. So if you look at the projection in terms of the gross financing needs of the government in the last 3 quarters of the year, they had projected to spend about 44 billion and all of that. But given the revenue shortfall, and also remember that the exchange rate at the at the end of first quarter, second quarter, thereabout, there was aggressive strengthening, but we've also seen a reversal to some extent somewhere along the line, which will also cause the debt stock in nominal terms, in terms of market to market, to go up a bit. Overall, you will notice that the drastic fall in our debt to GDP ratio was enabled by 2 main reasons. The aggressive strengthening of the currency. If you mark our external debt to market, in terms of, if you look at it in CD terms, there was a decline. Then again, the drastic expenditure cut, which also reduced government gross financing needs, and the government actually called that the shock therapy, also resulted in a negative rate of debt accumulation. And also, but however, if you look at our debt in nominal terms, the level of borrowing would increase. Remember that part of the borrowing is also refinancing and all of that. But if you look at it in terms of our debt to GDP ratio, it doesn't present a disturbing scenario if you look at it, because you also have to look at the rate of GDP growth and then relate that also to the rate of debt accumulation and all of that. So for me, that is not strange. Let me put it that way. That is not strange. Even though government has frank expenditure, we are talking about fiscal discipline and all of that. A considerable level of borrowing is expected in order to balance the books and also meet our refinancing obligations.
But in terms of the 10 billion injection and the marginal increase, okay, I can't say it's even marginal, but we've seen some increases in our debt stock. You are saying we shouldn't be worried about it. Is that the argument?
Yes, I don't think that it presents a bigger concern here. And here, my considered view will be is that let's not major on the minor. If you look at the October debt sustainability analysis that the IMF released, Ghana has exited the high risk of debt distress category. We have exited that. In fact, we are considered as a moderate debt risk country right now, given our economic fundamentals, institutional, and all of that. Remember that Ghana officially entered the high risk of debt distress category in 2014 under the previous NDC administration. So that debt classification, that occasioned the 16th IMF supported program that kicked in from April 3rd, 2015, and then ended in April 2019 with 1 year extension after the NPP took over. Okay, so and that was the reason why President Mahama, I think on the 6th of August 2014, made a call to IMF for the 16th IMF supported program. We exited that program in April 2019 without being able to restore debt sustainability. So it was one of the big drawbacks of the 16th IMF program that we achieved a number of the parameters in terms of the program objectives, but Ghana could not restore debt sustainability under the 16th IMF supported program that ended in April. You can check the concluding program debt sustainability analysis that was done. We were still classified as a high risk of debt distress.
Okay.
This was the tag the country had and was made worse towards the end of, actually from the third quarter of 2021 and running to 2022, where eventually we went for the 17th IMF supported program as we are counting it here, even though on the IMF website they are saying that we have been there 18 times. So,
but with our experience as a country, when we see that when conditions become a bit better, our leaders then develop that penchant for borrowing. If we see the debt stock going up, even though you say we shouldn't be worried, must that not, get us to say, well, pay attention because we could possibly get back to where we were?
In fact, I'm not saying that we should not pay attention, but what I'm saying is that we must look at it comprehensively. We have to look at it comprehensively. Of course, there are issues that we need to keep our eye on, monitor that continually. But look, frankly speaking, if you look at the amended Public Financial Management Act, which the government did this year, where we have enshrined debt limit rules now in our Public Financial Management Act. Remember, until the amended Public Financial Management Act, we used to have the Fiscal Responsibility Act, which set the debt fiscal deficit at 5% of GDP. Remember that the Fiscal Responsibility Act had been done away with. Now we have integrated the debt limit rules into the amended Public Financial Management Act. That expressly stated or has stated our debt to GDP ratio that we are targeting at 45%, and the goal is to reach this 45% by 2034 or earlier. Now, under the IMF supported program that will end somewhere middle of next year, we are supposed to reach debt to GDP ratio in present value terms of 55% by 2028. Even though the target is 2028, you will notice in the 2026 budget presentation, the Minister of Finance indicated that they have achieved 45% debt to GDP ratio far ahead of the 2028, where the target was 55%, and then also far ahead of the 2034, where the target was 45%.
Okay.
This is my reading of it. This is my reading of it. As I conclude briefly, my reading of this is that we have actually fast-tracked the debt target way ahead of time.
Okay.
So going forward, government can accommodate a considerable level of borrowing and also reduce the primary surplus of 1.5% without compromising our debt sustainability outlook, which we have set even by 2028 or 2034.
Okay.
So the important question we need to ask ourselves now is that we have now fiscal space to accommodate a considerable level of borrowing. That is what it means.
Okay.
But the important question now to be is that where are we investing this borrowing? And what is the level of efficiency and the higher value for money for every CD we borrow or every dollar we borrow? Because there's space now.
Okay.
We are no longer talking about debt to GDP ratio of
right.
70% or 80% and all of that.
Okay.
Of
Thank
course,
you very
I
much.
also take into cognizance that our
Okay.
debt service ratio is a little high and we need to improve revenue.
Okay.
But we need to look at all of them comprehensively so that we are able to guide ourselves without causing unnecessary anxiety in the market.
All right, thank you very much, Professor Godfred Bokpeng. Yeah.
Yeah, in fact, I agree with Prof when he said that there's been fiscal prudence this year. But we also need to put across that the reason why we've been able to leave that high fiscal debt, space, and we are now in a very good situation is because we did debt restructuring.
Yeah.
Just about 2 years ago, the Bank of Ghana itself had to forgive this government about over 40 billion cedis worth of, debt that it owed them. Individuals had to take haircuts. On the external side, we had to get moratoriums, we had to get haircuts from Euro bonds and all of that. That is what actually reduced our debt significantly. But currently, the reason why our debt is coming down, maybe we've been able to finalize some of the debt agreement, but significantly because of the pumping of Forex intervention. People don't like to use the word pumping, but Forex interventions actually really help the exchange rate situation to improve. That is why we are at the level where we are at the moment. Just look at this curve and you see the amount of monies in terms of billion US dollars used so far since 2022 to save the city. About 16 billion US dollars used to save the city. But significantly, what I would say is that we are here possibly or significantly because of the haircuts and the restructuring we did, and maybe because of the significant improvements in fiscal discipline, and then as well, the exchange rate situation, which is taking the source of strength from the gold board. But what happens if gold prices begin to fall? Are we likely to see the exchange rate going in a certain direction that we don't want it? And how does it affect our debt situation? Because remember that we might not be able to get forgiveness again in the debt space when the exchange rate brings it back to the level where we don't want to be.
Sustainability is what Kofi Ajay is talking about. Let's see how that particular one plays out. This is still the AM show. We'll take a break here. We'll be back with more, please. Just stay.